The S-Corp election is one of the most effective payroll tax reduction tools available to any small business owner. On $300,000 of net profit, structuring your compensation correctly can save you between $13,000 and $15,000 a year in payroll taxes. But the election itself doesn't save you anything. How you actually pay yourself does. Here's the core mechanics, because everything else in this video depends on understanding this first. When you operate as a sole proprietor or a single member LLC, 100% of your net business profit is subject to self-employment tax. On $300,000 of net profit, that's roughly $34,000 in self-employment taxes before a single dollar of income tax. The S-Corp election changes this by splitting your compensation into two buckets. You pay yourself a W-2 salary and payroll taxes apply to that salary. The remaining profit you take as a distribution, and distributions are not subject to payroll taxes. They flow through to your personal return as ordinary income, but that 15.3% self-employment rate doesn't touch them. So let's say your business generated $300,000 in profit and you pay yourself a $120,000 salary. Payroll taxes only apply to that $120,000, not the full $300,000. The difference is roughly $13,000 to $15,000 in annual savings. That's the benefit when this is structured right. Now here's where most business owners that filed an S-Corp start making expensive mistakes. The IRS requires that every business owner who files as an S-Corp and is actively working their business pay themselves a reasonable salary for the work they do. Now you might be thinking, well, the obvious move to maximize the payroll tax saving is just minimize your salary. Let's say you could pay yourself just $1 and take everything else as a distribution. You'd eliminate almost all payroll taxes. The IRS knows that's exactly the motivation, and unreasonably low compensation is one of the stated S-Corp audit priorities. Here's something that doesn't get talked about as much. If your salary is too high, that's also a problem. Some business owners pay themselves more than a reasonable amount. That could be because they wanted a higher income on record for a loan or a mortgage application. Their accountant could have set it years ago and they've never revisited it. Or it could just be because it felt safer to have a higher income reported to the IRS. Every dollar above what's reasonable is a dollar you're paying unnecessary payroll taxes on. So what does reasonable actually mean? The IRS looks at your role, your industry, your geography, and what someone with your credentials would earn doing your job in the open market. It changes as your business grows, which is why this should be revisited every year, not just set up once and then left alone. Once your salary is set correctly, the remaining profit of the business comes to you as distributions. Those distributions pass through to your personal return as ordinary income, but payroll taxes don't apply. That's where the actual annual savings comes at the $300,000 income level. Now, two things about distributions that catch business owners off guard. First, distributions have to be proportional to ownership. If you have a business partner who owns, let's say 30%, any distributions the business makes flows 70-30. You can't pay one owner more than their ownership percentage allows. The IRS is explicit about this, and disproportionate distributions create a separate set of problems. Second, distributions can only come from actual earnings. You can't take a distribution if the business doesn't have the profit to support it. Now, that sounds obvious, but it creates a real problem when owners start treating their business bank account like a personal checking account, pulling money when they need it, transferring cash informally throughout the year, and planning to sort out the classifications at tax time. And so this is where the third element comes in, because the informal pulling behavior usually ends up misclassified as a shareholder loan, and that's where the next round of problems starts. A shareholder loan is when the S-Corp lends money to you, the owner. Unlike a salary or a distribution, a loan isn't taxable income when you receive it. You're pulling cash out of the business, but because it's technically a loan, it doesn't show up in your personal return as compensation. And that's exactly why the IRS scrutinizes them. For a shareholder loan to survive audit scrutiny, it has to actually look and act like a loan. That means a promissory note with a defined loan amount, an interest rate at or above the IRS applicable federal rate, a repayment schedule, and real repayments being made. If the loan is never paid back, or if there's no documentation at all, the IRS will treat it as a distribution or as a disguised compensation, which means back payroll taxes, accuracy penalties, and interest on the whole amount. Now, most conversations about business owner compensation stop at salary, distributions, and loans. and those three matter. But here's what almost nobody talks about, because a lot of this information is coming from either a CPA or a business consultant, and where I see some of the most expensive overlooked planning mistakes. All three of these compensation decisions interact directly with your personal tax picture, and most business owners are making them in isolation from that picture. Your W-2 salary determines your retirement contribution within the business. A 401k contribution limit is calculated as a function of your compensation. If your salary is set too low, you're capping the amount you can put away tax deferred. That's a real planning cost that never shows up on the payroll tax calculation. On the distribution side, a large distribution year pushes your modified adjusted gross income higher. Depending on your total income, that can affect whether you qualify for ACA health insurance premium subsidies, whether you trigger the 3.8% net investment income tax, or how other deductions phase out. I'm going to be honest with you here. This is the part that separates a compensation structure that's technically correct from one that's actually optimized for your situation. Optimized means the salary and distribution decisions are modeled against your personal tax return, your retirement contributions, and any income thresholds that affect your other benefits. If you're not planning for both your personal and business taxes, you're missing out on huge opportunities. Here are a few action items you can do today to put this all together. The first step is the salary. Determine what's reasonable for your role and document it. Get a real market data comparison and revisit it every single year. The second is distributions. Take them on a regular cadence based on actual profit after salary and business expenses are accounted for. And third is shareholder loans. Use them only when they're structured correctly from the start. Remember, a promissory note, compliant interest rate, and repayment plan and repayments being made. And only when they genuinely make sense. A loan is a short-term cash management tool. It's not a classification you apply to an informal transfer after the fact. And then the fourth step is to model all three of these against your personal return. And in my opinion, I think that's one of the most important, because if you're trying to make decisions like this and your business is living in a vacuum, you're making decisions only on part of your income and your financial picture. Without planning for both, you're leaving a lot of real money on the table. If you're a business owner and you're not certain your salary distribution split is where it should be, or you've never had someone model how your compensation structure connects to your full personal tax picture, I have a business tax efficiency score you can get in less than 90 seconds. You'll see how efficient you are with your taxes and what areas can be improved. Click the link in the description below. You'll see how either efficient or inefficient you are with your taxes and what areas can be improved. Click the link in the description below to get that score today.